I made my first million when I was 45 years old, and my first 100 million when I was nearly 80. You want to know what the difference was between those 2 points in my life, what the great secret was? It wasn't some magic stock pick. It wasn't a brilliant market timing call. It was simpler than that. I just stopped thinking like a poor person. Everyone is out there searching. They're looking for the secret formula, the hidden gem, the one weird trick that will make them rich overnight. They want the algorithm, the newsletter, the guru's blessing. Let me tell you something. There is no secret. It's a fantasy. A ghost story people tell themselves to avoid the hard, boring truth. The real path to wealth isn't about what you do. It's about what you avoid doing. It's not about finding the winning moves. It's about systematically eliminating the losing ones. There is simply a list of catastrophic, boneheaded mental errors. If you can manage to avoid them, you cannot help but win over time. I have watched brilliant people, people with 160 IQs, absolutely incinerate their own fortunes. They didn't lack intelligence. They lacked the right mindset. And these 9 mental traps I'm about to give you will cost you more than just money. They will cost you decades of your life. Your one precious, non-refundable life. So today, I'm going to give you that list. The 9 fundamental mindset shifts that separate the wealthy from everyone else. And I'll tell you this right now. If you recognize yourself in just 3 of these, you are already 15 years behind schedule. Let's start the clock. Mindset shift number 1. You are actively seeking complexity when you should be ruthlessly mastering simplicity. This is a fool's errand, completely backwards. You think that the more complicated the strategy, the more jargon-filled the analysis, the smarter you are. You think you found an edge. Me? I look for the 1 or 2 simple variables that drive 90% of the outcome. The rest is noise, intellectual vanity. I want an investment thesis so simple, I could explain it to a bartender and they'd nod their head. Why? Because simple is robust. Simple is hard to break. Complex systems, well, they break in complex and unpredictable ways. Look at the history. Long-term capital management, a hedge fund run by Nobel Prize-winning economists. Their computer models were so complex, they probably needed their own power grid. They had leveraged themselves 100 to 1 on the belief that their mathematical genius could outsmart the simple, brutal reality of risk. And in 1998, they blew up so spectacularly they nearly took the entire global financial system with them. They were drowned by a level of complexity they themselves created. They were the smartest guys in the room, right up until they were the poorest. And yet, here you are. You spend 10 hours trying to understand a biotech company's phase 3 trial data or a tech firm's derivative hedging strategy. But you can't explain in one simple sentence how the business actually makes money. That's not investing. That's mental masturbation. You're more in love with the feeling of being smart than you are with the process of getting rich. Here's the rule, the Feynman test. Before you invest a single dollar, ask yourself, can I explain this idea, its business model, and its risks to an intelligent 12-year-old to the point where they could accurately repeat it back to me? If the answer is no, you do not invest, period. Your homework is this. Tonight, go through your entire portfolio. For every single holding, write down its business model in 1 sentence. Not a paragraph, a sentence. If you can't do it, sell it. Sell it tomorrow morning. Mindset shift number 2. You are trying to learn from your own mistakes instead of the mistakes of others. This is the single most inefficient way to learn anything. It's arrogant, it's painful, and it's slow. You think every lesson has to be seared into your own skin to be learned. Wrong, utterly wrong. Me, I'm not smart enough to have to make every mistake myself. The world is too full of them. So I read history. I read biographies. I read about every major business failure, every stock market bubble, every financial fraud I can get my hands on. I want to learn the patterns of disaster vicariously. It's cheaper, and it's faster. The world provides you with an endless library of human folly. The South Sea bubble of 1720, the tulip mania, the dot-com bust of 2000, the housing crisis of 2008. The stories are all the same. Greed, leverage, new paradigms, and the four most dangerous words in investing. This time it's different. It is never different. The technology changes, but human psychology is fixed. Why on earth would you choose to relearn that lesson with your own life savings? You spend an hour researching a $50 toaster oven you want to buy. You read all the reviews. But you'll throw $10,000 at some speculative stock you heard about from your brother-in-law because it has a cool story. You are learning the hard way, and the hard way is the expensive way. Here is the simple rule. Never invest in a business or an industry until you have read about at least one major historical failure in that exact same space. Understand how it died before you bet on how it will live. Your homework: go online and read the full story of the collapse of Enron or the story of Bernie Madoff. Pick one great financial disaster, read it, internalize it. Make their mistakes your teacher so they don't have to become your experience. Do this once a month. Mindset shift. Number 3, you focus on earning money while the rich focus on not losing it. Your entire mental energy is directed at the upside. How much can I make? Can this 10x? You're playing offense. All offense. You're swinging for the fences with every single pitch. This makes my head hurt. It's the mindset of a gambler at a casino, not a builder of wealth. My first, second, and third question is always, how can I lose money here? What has to go wrong for this to be a permanent loss of capital? I am obsessed with the downside. I play defense. Because if you avoid the big losses, the big wins take care of themselves. Warren Buffett said it best. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Look at the cautionary tales. Professional athletes, lottery winners. Mike Tyson earned hundreds of millions of dollars. He was an earning machine, but he lost it all. Why? Because he had no concept of capital preservation. He was all offense, no defense. The money came in fast, and it went out faster. The world is full of people who made a fortune and lost it. It's far rarer to find people who built a fortune slowly and kept it. You see a stock that's down 90% and think, wow, it's so cheap. If it just gets back to where it was, I'll make 10 times my money. You're only seeing the potential gain. I see a business that has already demonstrated its capacity to destroy 90% of its shareholders' capital. I see a catastrophic failure. We are not looking at the same thing. Here is your new rule, the inversion test. Before you make any investment, you must first write down the 3 most likely ways it could fail completely. Be specific. A new competitor, a change in regulation, a technological shift. If you cannot stomach those potential outcomes, or if they seem too plausible, you walk away. Your homework: calculate your oh shit number, the absolute maximum percentage of your portfolio you are willing to lose in a single year before you would panic and do something stupid. Write that number down. Now, review your holdings. Are you positioned in a way that makes exceeding that number a real possibility? If so, your defense is too weak. Fix it. Mindset shift number 4. You are trying to be a specialist in a single field, when you should be a generalist with a latticework of mental models. You're the expert in your narrow domain. You're a great software engineer, or a great doctor, or a great marketer, and you think that expertise will translate to being a great investor. It won't. In fact, it's a handicap. This is the man with a hammer syndrome. To a man with only a hammer, every problem looks like a nail. Me, I strive to have a whole toolkit. I build a latticework of mental models in my head. I want to know the big, powerful ideas from all the important disciplines: physics, biology, psychology, history, mathematics. I want to see the world not from one perspective, but from 100 different perspectives, because all the real opportunities and all the real risks exist at the intersection of these disciplines. The classic case study is Kodak. They invented the digital camera. They were the best chemists and materials scientists in the world when it came to film photography. They were the ultimate specialists. But they couldn't see the digital revolution coming. Why? Because it wasn't a chemistry problem. It was a problem of psychology, how people share memories, of technology, Moore's law, and of business models shifting from consumables to hardware. Their specialized lens blinded them. They had a hammer, and the world had just invented the screw gun. You're a tech investor who doesn't understand human psychology, the power of incentives, or the cycles of history. You're doomed to be surprised when people act irrationally, when greed turns to fear, when a brilliant technology fails because the business model is flawed. The rule is this: the multi-model gut check. Before making any significant decision, financial or otherwise, you must be able to identify and apply at least 3 big ideas from 3 different disciplines to the problem. If you can only see it through one lens, you are not seeing it at all. Your homework: pick a discipline you know nothing about. It could be evolutionary biology or cognitive psychology. Go buy the most popular introductory book on the subject. Read it. Don't just skim it, study it. Find one big idea from that book you can apply to your own life or investments. This is how you start building your latticework. Mindset shift number 5. You are chasing trends when you should be patiently operating within your circle of competence. You see something getting hot in the news. AI, electric vehicles, crypto, and you feel the itch, the fear of missing out. You think, I have to get in on this. This is a recipe for disaster. It is a guaranteed way to buy high and sell low. Me, I have a very clearly defined circle of competence. It's the businesses and industries I can understand deeply. My circle is not very big, but I have made it my life's work to know the boundaries of that circle, and I almost never step outside of it. I don't care what's hot. I don't care what everyone else is buying. I wait for the world to serve me up an opportunity, a fat pitch, right in the middle of my own little circle, and then I swing hard. The dot-com bust of 2000 is the ultimate lesson. People were quitting their jobs to day trade internet stocks. They bought companies like Pets.com, which had no profits, no viable business model, nothing but a cute sock puppet mascot and a good story. They were chasing the trend. They were operating miles outside of any circle of competence. And when the bubble burst, they were wiped out. Meanwhile, people like Buffett were being mocked for not getting it. He was buying boring companies like Coca-Cola and See's Candies. He stayed in his circle, and he ended up owning the whole casino. You feel like you need to have an opinion on everything. You think you need to be invested in the next big thing. This is your ego talking. It's a weakness. The strongest position is to be able to say, I don't know, or that's too hard for me. Here's the rule, the weighting test. Could you write down your strict investment criteria on a piece of paper and then sit on your hands, in cash, for 2 full years if nothing came along that met those criteria? If the answer is no, you're an addict. You're addicted to action, not to results. Your homework: Define your circle of competence. Write it down. Be brutally honest. What industries do you truly understand at a granular level? What business models can you explain backwards and forwards? Your list might be very short. That's fine. Now, make a solemn vow to only invest within that circle for the next year. No exceptions. Mindset shift number 6. You value opinions and stories when you should value facts and disconfirming evidence. You get your investment ideas from charismatic CEOs on TV, from confident pundits, from articles with exciting headlines. You fall in love with a good story. This is emotional, it's human, and it will make you broke. Me, I am a machine for destroying my own best-loved ideas. I don't look for information that confirms my beliefs. I actively hunt for evidence that proves me wrong. It's a process called disconfirmation. I want the cold, hard, brutal facts. I want the numbers. The story is the last thing I care about. The greatest modern example is Theranos. Elizabeth Holmes was a brilliant storyteller. She had the black turtleneck, the deep voice, the grand vision of revolutionizing healthcare. The story was incredible, and the most powerful people in the world bought it. They invested billions, but they never demanded to see the facts. They never asked the hard, disconfirming questions. It turned out the technology never worked. It was all a story. A very, very expensive story for the investors who chose to believe instead of to verify. You read the annual report from a company's management, and you believe every word. You don't think for a second that it's a sales document crafted by experts to present the company in the best possible light. You take opinion as fact. The rule is this: the disconfirmation rule. Before you invest, you must actively seek out and write down the 3 strongest arguments against your own thesis. Don't just think about them. Write them down. Then, you must be able to refute those arguments with hard facts and data. If you can't, you are operating on faith, not analysis. Your homework: pick one stock you own that you love, the one you're most excited about. Now, go online and find the most intelligent, well-reasoned bearish argument against that stock you can find. A short seller's report, a critical analyst's take. Read it. Force yourself to understand their point of view. It will be painful. It will also be one of the most valuable things you can do. Mindset shift number 7. You are seeking immediate gratification when you should be playing the long game. You check your stock portfolio every day, maybe every hour. You get a little dopamine hit when it's up, a little shot of cortisol when it's down. You're focused on this week, this month. You want to get rich now. This is a terminal disease for an investor. It forces you to think in ticks and wiggles instead of decades. Me, I am trying to buy a piece of a wonderful business that I would be happy to hold for 30 years. I am a partner in that business. The daily stock price is just noise. It's the manic depressive Mr. Market offering to buy my business from me or sell me his. Most days his prices are foolish, and I just ignore him. The power of wealth creation comes from compounding. And compounding needs one thing above all else: uninterrupted time. Look at any day trader. 95% of them lose money. Why? Because they are addicted to the immediate. They trade on noise, on rumors, on tiny scraps of information. They are playing a slot machine. The classic Stanford marshmallow experiment proved it with children. The ones who could delay gratification and wait for the second marshmallow were vastly more successful later in life. The stock market is just a giant global marshmallow experiment for adults. You sell a great company after it's doubled because you want to lock in a gain. You've just pulled your best flower to water your weeds. You've interrupted the single most powerful force in the financial universe: compounding, for a tiny short-term psychological reward. It's madness. Here's the rule: the 10-year test. Before you buy any asset, ask yourself this question: would I be happy to own this if the stock market were to close for the next 10 years? If the answer is no, you are not investing, you are speculating. Your homework: delete the stock market app from your phone. Right now, commit to only checking your portfolio once a week, or even better, once a month. Free your mind from the daily noise and start thinking like an owner, not a gambler. Mindset shift number 8. You blame external factors when you should be practicing extreme ownership. When you lose money, it's the Fed's fault. It's the market's fault. It was a black swan event. It was that analyst's bad call. It's always someone else's fault. This is the mindset of a victim. And victims do not get rich. Me, every mistake is my mistake. I am responsible for every outcome in my portfolio, good or bad. I made the decision to buy, I made the decision to sell, or I made the decision to do nothing. It is always on me. This isn't about self-flagellation. It's about learning. You cannot learn from a mistake you do not own. Read the memoirs of failed CEOs. It's a masterclass in blame shifting. It was the economy. It was a competitor's unfair practices. It was the regulators. Now, go read Ray Dalio's book, Principles. It is a brutal, honest, painful audit of every single mistake he ever made. He catalogs his errors so he and his organization will never repeat them. One of these men is one of the most successful investors in history. The other is a footnote. You bought a stock, and it went down. You blame the company's bad earnings report. But whose fault was it for not anticipating that the business was in a cyclical industry? Whose fault was it for paying too high a price? Whose fault was it for not having a sufficient margin of safety? It was your fault, always. The rule is this, the post-mortem rule. Every single time you lose a meaningful amount of money on an investment, you must sit down and write a one-page post-mortem. It must not contain any external blame. It must only detail what you did wrong in your analysis, your process, or your emotional discipline. Your homework: think of the last investment you lost money on. Write that post-mortem. Right now. Be honest. Be brutal. It's the only way to get better. And finally, mindset shift number 9. You think in terms of first-order consequences when you should be thinking in systems and second-order consequences. You see the immediate effect of an action, and you stop there. You think one move ahead. Like a novice chess player, this is a shallow and dangerous way to see the world. Me, I am always asking, and then what? For every action, there is a reaction, and that reaction causes another reaction. I am trying to think through the whole chain of events. I am not playing checkers, I am playing three-dimensional chess. The first-order effect is often seductive, but the second and third-order effects are where the real danger and the real opportunity lies. The classic example is the Cobra effect from British colonial India. The government was concerned about the number of venomous cobras in Delhi, so they offered a bounty for every dead cobra. A simple first-order solution. And it worked. People brought in dead cobras and collected the money. But then what? The second-order effect kicked in. Enterprising people started breeding cobras in order to kill them and collect the bounty. The cobra population exploded. The government, realizing their mistake, canceled the program. And then what? The cobra breeders, with their now worthless snakes, simply released them. The wild cobra problem was worse than it had ever been. A simple solution led to a disastrous outcome because no one asked. And then what? You vote for a politician who promises to put a tariff on imported goods to protect local jobs. That's the first-order effect. But you don't think about the second-order effect. Other countries retaliating with their own tariffs, making the things you buy more expensive and hurting your export industries. You are only seeing the first move on the board. The rule is simple, the and then what test. For any major decision, you must map out the consequences. What is the immediate result? Okay, and then what? What will be the reaction to that result? Okay, and then what? You must follow the chain at least 3 to 5 steps down the line. Your homework: pick a major news story, a new law being passed, a big corporate merger, a technological breakthrough. Sit down with a piece of paper and apply the and then what test. Map out the chain of consequences as far as you can see. This will train your brain to stop thinking in simple, linear terms and start seeing the world as the complex, interconnected system that it is. So there you have it, the 9 shifts. Stop seeking complexity. Learn from the mistakes of others. Protect your capital like a fortress. Think broadly with many models. Stay in your damn circle of competence. Demand facts, not stories. Be pathologically patient. Own every single one of your mistakes and see the whole chessboard. It's not about being a genius. It's about having a discipline that prevents you from being an idiot. This path will not make you rich next year. It's not sexy. There's no Lambo at the end of this rainbow next Tuesday. But in 20 years, in 30 years, when the trend chasers and the gamblers are right back where they started, you will be financially free. It is an inevitability. Look, most people clicked off this video 10 minutes ago. They're already searching for top 5 AI stocks to 100x. If you are still listening to my voice right now, it's because you're serious. You are part of the small percentage of people who actually get it. You understand that this is a marathon, not a sprint. This channel isn't about hot tips. It's not about predicting the market. It is about installing these timeless mental frameworks that build real, lasting, generational wealth. If that's what you're looking for, you know what to do. Hit that subscribe button. That's all for me. Now, go read a book about a business failure. It's the most boring and most profitable thing you can do with your time.